moving towards a new paradigm, the combination of human judgment and machine intelligence.
The world of investing, where are we going?
The equity world has started to realize that the thing that interferes with their alpha is macro.
Mahmood, how long have you been working in finance?
About 30 years. The big challenge with macro is that you have this sea of tangled information. We all have so many variables to look at. Monetary policy across all the major central banks, QE, QT, inflation rates everywhere, GDP growth, banking sector stress in Europe, China stress. Investing is increasingly becoming about the analysis of data. To run a lot of the algorithms we need it to make things go fast.
Clients using QI manage upwards of 7 trillion in assets.
We use high-frequency data that makes the macro problem solvable, so they can focus on what they do best, bottom-up alpha generation. We have tasked the machine learning algorithm with beating a particular index. We are now seeing a new, much less stable equilibrium. Globalization has kicked into reverse. One shadow that hangs over the global economy is
where are we going in the world of investing? Mahmood, very excited to do this. Welcome to the show.
Thank you, Eddie. Pleasure to be here.
Awesome. So I think it's always useful just to start, give a bit of context about your background, where you worked before. So how did you first get into trading?
So I did a undergrad and postgrad in economics at the LSE in London. And then I had this crazy idea that I wanted to do a PhD, and so I had all my applications ready. And then for some reason, I thought to myself, maybe it would be a good idea to get a taste for the real world for a couple of years. And so I applied to Morgan Stanley and got a job as an analyst. And here I am.
And not to age you too much, but how long have you been working in finance?
About 30 years.
Wow, okay. A bit of a veteran then.
Absolutely.
How much money were you managing at your peak at some of these kind of hedge funds?
At the peak, I managed a team running about $1.4 billion. I managed half of that and the rest of the team, the rest of it. And we were running a cross-asset macro and macro relative value strategy.
Perfect. So going back all the way 30 years and then going back to today, how has the world of investing changed since you first started?
Really is absolutely incredible. I remember walking up to the treasury trader at Morgan Stanley in the early 90s and realizing that if you had asked them, where is the S&P 500 right now, or where is the price of crude oil, they probably wouldn't have known. And you had these completely segmented asset classes. The equity world was in one place, the fixed income world was in another place. And one of the biggest changes is how interconnected everything has become. And we have, of course, had this huge globalization. Nobody really knew where China GDP growth was in the mid-90s, and nobody really cared. And now it's so critical. We've had the arrival of new asset classes like the credit markets that are very liquid. And what we see now that is very different is that everything is so interconnected. So if something happens to disrupt one asset class, then basically that impacts everything. And so the big changes really can boil down to this increasing interconnectedness, information flowing much, much faster than it did 30 years ago with the arrival of the digital age. And so the other thing that's happened, of course, is we now live in the big data age. And so the amount of data that investors have access to is overwhelming. And I think everyone just has too much. There are some other big structural changes, and that is we are now seeing the arrival of the retail investor on the investing scene. Passive is this long-term secular trend. Passive flows now are something like 60% of daily US equity volume. So we've really seen dramatic changes in the last 30 years.
So what are the key drivers of that? I would imagine tech, processing power, the advancements of tech have led to this, the participation of the retail trader. You can access everything on your phone. What other kind of drivers of that interconnectedness do you see?
Undoubtedly, technology has transformed not only our daily lives, but pretty much every single business out there. The other thing that has happened is that processing power has become very cheap. So you have this interesting situation about 10 years ago where you had the arrival of all sorts of data, including the alternative data boom that we have seen. And at the same time, you had this cheapening of processing power. And it was really that cheapening of processing power that unlocked what we call AI or machine learning today. A lot of the techniques and neural networks and all sorts of machine learning techniques have been around a long time. What has unlocked all of that is cheap processing power. And of course, you need the data to feed it all. So we've had all these things come together. And clearly now we are seeing a big shift towards quantitative techniques in investing. And one of the sort of core visions of QI is that investing is increasingly becoming about the analysis of data. And I think that is an enormous trend that's been growing for the last 10 years and is only going to accelerate.
And you mentioned that kind of the cheapening of processing power, for example. AI, machine learning, it's been around for actually a few years. I think the buzzword that is AI and ML right now, people don't really understand that it's, people have been utilizing it for trading and finance for, decades probably. How has the kind of spark of generative AI and, the more advanced AI that we've seen this year changed the game or could change the game for investing for hedge fund managers and money managers?
So I think that you've got the data-driven AI and machine learning, and that has been around, as you say, for decades. We have some amazing examples like Rentech and the big systematic funds, and they are using various techniques to find patterns in data. And that, in many cases, is a source of alpha. I think that generative AI, which is available to everyone, get your phone out, get ChatGPT, get various other types of AI. Those are really productivity boosting tools. And I think they are going to help analysts and portfolio managers just cover a lot more of the basic research way faster. So I see it more as a productivity support rather than being at the cutting edge of alpha generation, partly because everyone really has access to it. And the generative AI boom is spawning all sorts of competing and very cheap applications that everyone can use, and that limits the extent to which it can really be used to generate alpha now.
You talked a little bit about Quant Insight's kind of core mission and vision. Could you speak to that a little bit more in terms of what are you really trying to do and what is your vision for the next kind of 5 to 10 years?
The world of macro, which is the world I've lived in for a very long time, is somewhat notorious for being somewhat subjective. And everyone has a fascinating opinion, and all those opinions about whether Powell really sounded dovish or hawkish or gut feels about where we are in globalization, all those opinions are interesting. And in a sense, they're equally valid and they're equally useless. And what QI really set out to do was to put some sort of rigorous structure around macro. And the big challenge with macro is that you have this sea of tangled information. So we know that what's priced for the Fed in the next 12 months matters for equities. We know that China GDP growth matters, real interest rates, the cost of corporate credit, crude oil prices, the dollar, all these things matter. And we see all these macro variables moving around. And at the same time, we see an asset price moving around. And the core objective of QI was to basically use the data on macro and link that to the price action. So a typical question that you could use QI to answer might be, to what extent today is bad news good news? If we get weak data, is that positive for the S&P 500, or is that negative for the S&P 500? And of course, we go through these regimes that are quite dynamic. And you can have a couple of quarters where strong data is positive for equities, and then that can flip to a couple of quarters where suddenly strong data is negative for equities. The answer is underneath the surface somewhere within this massive correlated macro data. The opportunity we had was to harness processing power and scientific techniques to extract these deep relationships that help us understand what's really driving markets.
Clients using QI manage upwards of 7 trillion in assets. Can you talk about how these clients are actually using QI in their day-to-day? So Goldman Sachs Marquee, Omega Point, for example, how are their clients utilizing QI solutions?
The biggest use case for QI is now in the equity world. And this really started to fly in the last couple of years. And the reason for that is that, for example, equity long-short hedge funds had a quite challenging 2020 when COVID came along, and we saw real GDP growth collapse, and we had this massive deflation shock. And then again in 2022, they had an even more challenging time when global interest rates, both nominal and real, started to rise rapidly. And so the equity world has started to realize that one of the big influences on their alpha, or the thing that interferes with their alpha, is macro. And they don't really want to have a macro view. They don't really want to spend a lot of time becoming macro experts. But macro is this headache that comes along from time to time. And so one of the biggest use cases is equity funds using QI to understand the macro exposure of their entire portfolio. So what does that look like? Well, if I am an equity long-short portfolio manager today, I might be interested in the expected change in my portfolio if China real GDP growth goes from 5% to 2%. I might be interested in what happens to my portfolio if the credit cycle turns. And so at a broad level, you get this quantified macro exposure analysis. The next step is to then ask the question, okay, which stocks is this coming from? And QI allows you to drill down and actually have a look at exactly where these macro exposures come from. And then you can resize, which is what clients typically do, and scrub out the macro exposure of your entire portfolio. And I think that for equity funds, once they've scrubbed out their style factor risk and they've reduced their macro factor exposure, and they have, dealt with any sector bets and geographical bets, what is left is alpha. So the core use case of QI for equity fund managers is to help them become more confident about managing their macro and allowing them to focus on what they do best, which is generating bottom-up alpha.
You touched upon 2020 and 2022 just then. I think global fixed income lost 30 trillion in 2022. Obviously, there was sharp drawdowns in tech stocks because of higher interest rates and inflation driving the narrative. But what's those are two examples. What's the real cost of getting macro wrong? And if you flip it the other way, what's the opportunity of getting macro right for equity PMs or macro PMs?
Probably the most dramatic example that stands out for me, and it's something we saw from QI around January, February 2020, was that the sensitivity of tech to higher real interest rates became very negative. And we saw, for example, that a big hedge fund called Tiger Global had a very tough 2022. I think they lost around 20 billion, which was about 56% in their equity fund. And they really had a very large macro bet on in 2022. So here is an example of a bottom-up fundamental equity investor that when the environment changed, suddenly had this very big macro exposure. And if they had used QI, they would probably have very clearly seen they had this enormous bet on real interest rates and the wrong way round.
So that's a perfect example. But what's the real macro problem for an equity or a macro investor? Why is it so tough to actually cover or get right?
There are a lot of challenges when dealing with macro. One of the most obvious ones is that a lot of macro data is quite lagged. So real GDP growth comes out quarterly, and you only get the data a month after the quarter is ended. So by the time you get last quarter's real GDP, it's pretty useless and out of date. Inflation comes out monthly. There is now a lot of high-frequency data you can get hold of. So, for example, we use a source called Nowcasting that gives us daily real GDP estimates for 22 countries. We use the inflation expectations market for something like 7 countries. So we've managed now to get this high-frequency data that makes the macro problem solvable. Another issue with macro is that it's so difficult to untangle the fact that everything's correlated. You may have a correlation between Apple stock and the dollar, and you may have another correlation between Apple stock and what's priced for Fed funds in the next 6 months. But the problem is that the dollar and Fed funds pricing, they are both correlated. So what's really the causal factor here? And this is where we can apply a lot of data science and machine learning techniques to get under the surface of all the data, strip out all this cross-correlation, overlapping information and redundancy, and actually tease out the deep independent relationships between macro data and asset prices.
You've got some pretty insanely qualified people that are working on this and have worked on this. Can you explain what exactly the process was on some of the work that they did, and why this is so crucial, and potentially how this has never been done before?
Sure. Yes, we are very fortunate in that we've managed to combine 3 disciplines really to deliver this solution. The first is we wanted to access state-of-the-art machine learning expertise. And so we started working with Professor Michael Hobson at Cambridge. He used to be the chief data scientist at the Cavendish Astrophysics Labs at the University of Cambridge. And applied astrophysics is really interesting. And in fact, Jim Simons, in one of his interviews a couple of years back, I think at MIT, mentioned that Rentech primarily hires applied astrophysicists. The reason for that is that they deal with very large, noisy data sets, and what they're trying to do is find signal in that noise. And that's quite similar to the financial market problem. And so what the scientific aspect allows us to do is to really think about how you model noise and how you extract signal from data. So yeah, we have both Mike Hobson and Ryan Prescott Adams, who's professor of computer science at Princeton in the States, and Ryan taught machine learning at Harvard, sold his AI startup to Twitter in 2015, and then worked for Google Brain, and he advises us as well. So one area is the science, and we really went all out to access the best expertise. The second aspect is really technology. And what we realized is that to run a lot of the algorithms we need at scale, covering something like 10,000 assets, we needed to make things go fast. And so our CTO, Paolo, came from the European Space Agency, where he basically was responsible for building processes that made things go really fast. And so that was the technology piece. Finally, we realized that another obviously critical piece was market understanding. And so we put together a team of myself, Christian, my co-founder, who really comes from the equity side, was a fund manager at Fidelity, was an equity macro PM at Brevin Howard, Amit Khanna, who was the lead equity strategist at Brevin for 9 years, Hugh Roberts, who was on the fixed income side at Credit Suisse. And so for us, those three pieces were really important. The science, the technology, and the market expertise.
Yeah, wow, that's a real wealth of experience there. When you were building QI, what was the moment or potentially moments where you thought, wow, we've got something really special here?
So the first time I had a look at the S&P 500 model, it really was like, and I was a macro PM at the time, it really was like being a kid in a candy store, because I just realized that I could see what was actually driving the market. And that was an incredibly powerful moment. Over time, over the next year or two, we started to see some results that looked initially counterintuitive. We went and concluded that what's really going on under the surface is actually absolutely right. In 2012, we had the big stimulus from Japan. And I remember looking at all the equity models in late 2012, early 2013, and they were all throwing up credit spreads in Japan and various other Japan variables. So this was a great example of actually identifying that the real driver of global markets in that particular period was actually Japan monetary policy. And given how globalized and interconnected the world is, we all have so many variables to look at. Monetary policy across all the major central banks, QE, QT, inflation rates everywhere, GDP growth all over the place, banking sector stress in Europe, EM sovereign stress, China stress. It becomes almost impossible for the human eye to figure out which one of these is really doing the heavy lifting in driving asset prices. And so that Japan example really drove home to me that this was an incredibly valuable way to look at things.
And with rates going up dramatically to where they are now and that higher for longer narrative, surely macro is going to be dominant for years to come.
Yes, it's really interesting that we've had this big perception shift, and actually we did a poll of equity funds and found that 70% of them believe that macro is here to stay. Now, we had this period called the Great Moderation after the financial crisis, and inflation was very low, in fact, too low and stable. We remember all too well that interest rates were stuck at zero or even negative for years and years. The fixed income market just died. Volatility just died. Real GDP growth was sort of a trend. And macro volatility was really low. Now, two things have happened to shift us, I think, to a new, much less stable equilibrium. The first is there are some long-term secular trends that we saw for a good decade that have shifted. The entire globalization and offshoring has kicked into reverse, and we now have deglobalization. Part of that is the shift to free trade has now moved to emphasizing fair trade. We also have demographic changes, both in China, which are very well known, but also, for example, in the US, where 100,000 baby boomers are retiring every week. Immigration policies have shifted. So labor markets have changed quite fundamentally. So you have a lot of these long-term secular shifts that changed, and in short, they are a bit more inflationary. And the second thing we had, of course, was the huge COVID shock. And that has kicked us into a totally different inflation regime. And there are signs in some economies that we have a bit of a wage price spiral going on. And so if you add to that the huge increase in government debt and the much more activist fiscal policy we now have, it seems very likely that the next decade or so is going to be far more volatile from a macro perspective than those pre-COVID years.
And given that kind of elevated macro, let's say, sensitivity for many asset classes, what are some of the shortcomings of how this macro and the macro factors are handled in factor models? and risk technology today. So, put kind of more shortly, what might these current solutions miss, whereas QI, is very aware of, the big drivers?
So I think there's a few points there. One of them is that there is a tendency in investing to look for long-term relationships. Look at 30 years of data and try and find some fixed, deep truth. One of the challenges of macro is there is no fixed truth. The regime changes. It can change in 3 months, 4 months, 6 months, maybe, the longest regimes last 18 months. So you need to be really adaptive. And I think that is one of the things QI does well, because we recalibrate everything daily. So as the sands start to shift, the machine is picking up all those changes. The second aspect is that we are taking advantage of alternative data, as I mentioned, nowcasting and all the data that's now available out there to really help you understand what's going on. Thirdly, the equity world has had a bit of a go at macro, but given macro is not really their area of expertise, they haven't captured enough variables that really describe the universe of macro. And we think about it in 3 categories. Number one, economic fundamentals. You have to cover economic fundamentals, and that's real GDP growth and inflation. And relatively few of the models we've seen out there cover both of those in a high-frequency way. The second aspect is financial conditions. And financial conditions have many different aspects to it. Clearly, real interest rates. But then you have to add in the cost of corporate credit. If you're looking at a US stock, the trade-weighted dollar is part of financial conditions. A stronger dollar is tighter financial conditions. You then, these days, really have to take into account quantitative easing and quantitative tightening expectations. And given our macro backgrounds, we have found variables that are good proxies for the market's QE and QT expectations. And then finally, you really need to appreciate a lot of the risk measures out there. Sovereign stress in the Eurozone, banking sector stress in the Eurozone, EM stress. We use an interesting measure of risk aversion, which is the gold-silver ratio, that just gives you a measure of how worried global investors are. And that picks up crises like banking sector crises and SVB and events like that. So I think being adaptive, using alternative data, and being very comprehensive is where we perhaps stand out. And given our macro backgrounds, I think that that is the reason for it.
If I'm a CIO, equity PM, trader, macro PM, what exactly am I using QI for? Could you outline some really granular kind of workflows?
Yes, let's make it a bit more concrete. So what are the actual outputs? The first is a percentage number that tells you how macro or micro the price action of a particular stock is. So if you're looking at, for example, Apple stock, our model confidence number, if it's 40%, will basically tell you that 40% of the price action is explained by macro factors, and 60% of the price variation is explained by other things. In other words, idiosyncratic and other factors. And so on the equity side, portfolio managers find this pretty useful because it instantly tells them the extent to which they're taking a macro bet with that particular stock and the extent to which they're taking a micro bet with that particular stock. Now, what's interesting here is that when you look across sectors, you pretty much get the results you would expect. So if you look at utilities, industrials, financials, energy and mining stocks, you will find the macro model confidence is probably 60, 65, maybe even 70%. Those are much more macro-driven sectors. If you look at small cap biotech, the macro explanatory power might just be 5%. which again, if it's innovation-led, it's not about macro, and that's what you'd expect. So that's the first thing. And one of the interesting comments we had a couple of years back from a large equity fund was that this helps them understand where to spend analyst resources. There's no point spending all your equity analyst time on a European bank that's just about European stress and macro factors. You should probably deploy that elsewhere. So that's the first one. The second is what we call the macro DNA of the stock. And this is a map of how macro impacts this particular asset. So for example, if you're looking at Apple stock, you know that to some degree, going long Apple is a bet on China GDP growth. You know that going long Apple is a little bit of a bet on a weaker dollar. In fact, I think in their last earnings call, they mentioned the dollar as an impact on their earnings. And so QI gives you the entire sensitivity map for 8,500 single stocks globally, sectors and indices. So that's the second aspect. The third aspect is an interesting byproduct of the framework, and that is that if you have defined the deep underlying relationships between these various macro variables and the price, and if you know where all that macro information is right now, then you can calculate a price that is consistent with all the current macro information, a macro warranted value of the asset. And it's very common for people on a trading floor, for example, to talk about whether all the information is in the price. You get a non-farm payroll report and it's like, okay, was it already discounted, or, is this asset lagging or leading this kind of macro warranted value? And so this is a macro-based, rich, cheap measure that can be used to basically give you a bullish or bearish lean on a particular asset. There's another use case that is also very interesting and used a bit more in the macro discretionary world, and that is trade selection. So the way this works is you sort of turn the whole thing on its head and you start off with a macro view. And macro portfolio managers spend a lot of time developing their macro view for the next month or 3 months. And the next challenge for them is how they express it. So if I sit here today and decide, after all my research and analysis, that I am really negative on global GDP growth for the next few months, the question then is, what's the best way to express that? Is it short equities? Is it short the dollar? Is it long fixed income? And so QI allows you to input a macro view and get a short list of assets that are very sensitive to that view.
So I'm a bottom-up investor. I don't have time for macro. What do you say to that?
The advantage of QI is that for equity bottom-up fundamental investors, what it tries to do is remove the complication of macro, not add the complication of macro. I think it's very clear that many equity investors don't want to spend time generating a macro view or taking macro bets. The problem is that they have implicit macro exposures. And so the beauty of QI is that it helps them actually remove that from the equation so they can focus on what they do best, which is bottom-up alpha generation.
So from the risk management perspective, if I'm a PM, how can I use QI to help better manage those macro risks?
Step one is really knowing what your risks really are. And the easiest way to use QI is to use our API to bring in the macro sensitivities for each and every one of your holdings, and then based on your notional position to sum those all up, and then have a look at the expected change in your portfolio NAV for a change in each of those macro variables. And typically, PMs will look at this and risk managers will look at this both outright and relative to benchmark. And what we find is that if the macro exposure of your book is pretty much bang on the benchmark, that's less of an issue than if you have a big outlier relative to benchmark. And then the next step is to really start well, there's two things you can do. You can tweak your position sizes. So generally what we find is that clients don't want to change the names in their book, but they are much happier to change the allocations. And so you can change the allocations to squish your macro exposure across the board. That's one thing you can do. The second thing you can do is employ hedges and overlay hedges to reduce your overall macro exposure. And we have actually written a white paper that will be out soon that shows that every month consistently reducing your macro exposure increases Sharpe by something like 15%. So if you have a Sharpe of 1, consistently reducing your macro exposure can take that to a Sharpe of 1.15.
What are your thoughts on the next few years in terms of big macro drivers? What's going to be dominant, and what should equity PMs or macro PMs, risk managers be really kind of cognizant to?
I think one shadow that hangs over the global economy is China, the world's second largest economy. We have, I think for a good decade now, had lots of concerns about overinvestment and debt levels, shadow banking, and we have seen those start to increase. I think the second issue is the very large increase in government, personal sector, and corporate sector debt that we have seen in the G7 and developed economies. And I think there is a nervousness that if interest rates stay up here and inflation proves to be sticky, then we could see a very nasty turn in the credit cycle, a big increase in default rates, and a sharp drop in GDP growth.
Can you give me a real tangible example of how QI has added real value to an equity fund?
We have run a lot of analytics for our clients, and we have found many instances where during volatile macro periods, reducing their macro exposures has added around 4% return in the following quarter. And it's actually quite straightforward for us to demonstrate this with a new client and say, okay, let's have a look at how your exposures did and how your portfolio did from 2020 to 2023. And let's run a simple simulation where we'll look at your unadjusted returns, and let's run another version where we look at your book, let's say in January or February 2022, using point-in-time data. You run your QI risk report, so it would have shown you, for example, your exposure to real rates. And 2022 was an interesting one because the Fed was very clearly telling everyone they were going to hike rates a lot. And you can then show how the portfolio would have done had they reduced their real rate and interest rate exposure.
What asset classes does QI cover, and who uses QI today?
QI is quite comprehensive in terms of asset class coverage. So on the equity side, we cover around 8,000 stocks globally, major sectors in the US and Europe, global indices across both developed and emerging markets, hundreds of ETFs, over 100 FX pairs, interest rates, bond futures, commodities, and some credit indices. The users of QI today are everyone from very large, long-only asset managers, insurance companies, pension funds, equity long-short hedge funds, which is one of our biggest areas of activity, down to family offices and some investment banks as well.
You're working on some seriously exciting partnerships. Can you give us a sneak peek into what they are?
So one of the innovations we have developed is what we call baskets technology. This is an algorithm developed by Mike Hobson and his team in Cambridge that uses machine learning to construct a basket of stocks that mimics a particular variable factor. So, for example, if you think inflation is going to go up, how do I find 50 or up to 100 stocks that actually tracks inflation? Now, that is one area of activity, and we have announced a collaboration with Goldman Sachs. So QI's macro baskets are now available via Goldman Sachs. Another area that's related is we've taken our baskets technology and we've modified it to basically task the algorithm with beating a particular index. And so we have taken what is essentially AI and pointed it to the problem of, okay, if I have an index, let's say the CSI 300 in China, it has a particular history. We have tasked the machine learning algorithm to go and pick 100 out of those 300 every month in order to beat it. And this is a ETF that we are launching in partnership with Crane Shares on China.
I've heard you say macro is here to stay to equity investors before. What do you mean by that? Because surely macro's been here already.
What I'm really saying is the volatility of inflation, wage growth, real GDP growth, interest rates, cost of corporate credit, default rates, the ranges in which all those variables operate is basically going to continue to expand over the years ahead. And that means that your tail risks are that much bigger. I think we're moving to a world of much fatter tails.
How are progressive fund managers combining macro factor and style risk?
This is such an important question. And I think one of the best meetings I've had for a long time was about 4 or 5 months ago with a very large North American pension fund managing hundreds of billions of dollars. And they were really scratching their head because their style factor risk showed them that in middle of 2020, as the Fed was hiking interest rates, that 90% of their risk was idiosyncratic.
Wow.
And only 10% of their risk was driven by style. Now, that obviously meant that when they looked at that, what it was saying was, boy, you really suck at picking stocks. And your alpha contribution is heavily negative. Now, of course, we all know that in 2020, the reason markets went down is because the Fed was hiking rates. And so we did some work with them to integrate QI with their existing style factor risk framework. And they looked at a new risk report covering that same period that showed them both style and macro together. And lo and behold, their alpha contribution was actually positive, and the negative performance was picked up by their macro exposure. And so for them, this was a real revelation. And I think that's a fantastic model that we're trying to follow with many other funds out there.
What are your thoughts on the way that the world of investing is moving? You've talked about cheaper processing power, kind of the implementation of very sophisticated data science, for example. Where are we moving? Where are we going for the world of investing?
So I think one of the most interesting trends is the rise of the retail investor. And that is reflected in the rise of passive investing. And the narrative out there as we got to the end of 2021, middle of 2022, was that it's really easy to make money in a bull market. Everyone got on board, the Robinhood phenomenon. And the general expectation was that the retail investor would retreat. But what's really interesting is in the first couple of quarters of 2023, retail investor flow as a percentage of total flow actually hit a new high. So I don't think this shift is going away. And I think there's going to be a big convergence between the resources and expertise that institutional investors have access to and the expertise that retail investors have access to. And what that means is, and we see this already, is that big institutional investors are becoming far more active in trying to understand what the retail investor is doing. I also think that we're moving towards a new paradigm. And that new paradigm is really about the combination of human judgment and machine intelligence. And whether that is text-based generative AI or data-driven machine learning, there is no doubt that if you take human judgment and you combine that with the ability of machines to crunch data and draw insight from data, that is, I think, where we are going, and we're quite a long way down that road already.